Yeah, yeah, it's recorded. Okay. Hi, everyone. Thank you for your time. As Amit already gave the broad introduction, so basically, this report is essentially written to sort of understand what could really hit India if at all the tariff threats actually come true in the nature that they were essentially being noised at. At this point in time, there is not much of a clarity as to how the tariff would be imposed, what would be the nature of the imposition, whether it will be broad country level tariffs, whether it would be sector by sector tariffs. You are already seeing signs of that. Like today, there was a broad, auto sector tariff that was imposed by the US to any car which is not made in the US. And also they could probably go ahead and do tariff line based, so commodities subsector level tariffs as well. So there is not much of a clarity. There's a lot of winds and fancy in the way that the tariffs are as of now looking to be imposed. And it's very difficult to thus really come out with a very, very clear macro and sectoral implication for that. So we just tried to sort of play around with various scenarios and try to see whether, India could actually be as hit as people are fearing. Our understanding suggests that, of course, there is no doubt that there could be a possible, macro hit via the export route that we could face. But on a broad country level, even though, India probably could face a much higher relative tariff compared to its peer key economies, the the numbers are not very threatening for us. So we estimate that, assuming that we end up facing, say, a 10% broad, country level tariff, and we end up looking very bad compared to our peers because we impose much higher tariff on the US, and thus we will have a much higher additional tariff, which will be imposed by the US on us. The potential loss that we probably will be faced will be around 6 billion to our exports to the US, which is around 0.16 or 0.2% of GDP. Um, which is a very minuscule number. Just to give a broad sense, India exports roughly around $80 billion dollar worth of goods to the US, which is around 2.1% of GDP, of which the sectors which are more susceptible or more vulnerable to any kind of tariff threats which could be credible are essentially around 50% of that. India's export basket is also very concentrated to the US, which basically means of the 2.1% of GDP, roughly 1.1% of the goods are actually sort of exposed. And we also have tried to study those goods. So basically, the sectors that essentially are being talked about in various studies is basically auto, pharma, electronics, apparel, gems and jewelries, chemical to some extent, and all of these sectors essentially are indeed on paper exposed. But our study suggests that even though they are looking to be pretty exposed in terms of their tariff differential, the deep drill of these sectors suggests that sectors like auto, pharma, electronics, which are again key sectors for us, are actually far better placed than feared. On the other hand, we believe that apparel, gems, and jewelry are probably the most exposed one. And this we've tried to study from the sector level tariff. So, as I said, we don't have a clarity as to how they would be imposed. A broad country level tariff where they will do a blanket tariff to each and every country that export to the US, or they can do sector level assessment, or they can even go commodity wise or tariff line wise, which will be very, very complicated for the US because the tariff lines that they have with various countries amount to almost 2.5 billion plus. So that will be crazy for them to really get into that exercise. So our study has generally gotten is generally constricted to basically two scenarios. One is broad country level tariff, and second is sectoral level tariff. As I said, on both these scenarios, what we believe is that there is too much noise and too little an impact when it comes to the actual impact to India, because a lot of demand is also inelastic to some extent for the US as well. But nonetheless, of course, we don't know where and how these dynamics could play out, and we could actually lose out in some sense. Thus, we obviously need to have some deal with the US in terms of ensuring that the tariff impact on a relative basis to us would be much lesser. Thus, we also identify a few easy wins as an offer to basically mitigate some tariff risks that we can face, which basically could be either in the form of higher energy imports from the US, defense imports, probably lower foreign EV tariffs, and the likes of that. So basically, we try to sort of study where we have the opportunities, where we have some kind of insulation, and where we are actually very vulnerable if the US actually comes out and imposes tariffs on us. Harsha will take it forward from here on, and we'll be happy to stop in between and take your questions if you think it gets very mundane and very verbose from our end. Harshi, can you take it ahead, please?
Yeah. So, as Madhvi said, if a broad country level tariff is imposed, we think that the impact will be a lot less than what people have been saying. So, about 6 billion is the hit in terms of the 2026 estimated number of India's exports to the US. And as to put it in context, 77.5 billion was what our exports to the US was last year, FY24. So this number is about 7-8% of that. And as mentioned earlier, just under 0.2% of GDP, with total exports to the US being about 2.1% of GDP. Of course, if the tariff rate imposed on India is higher, and this we're saying the incremental tariff rate, if that is higher, then of course the hit is worse. So at 25% tariff, the estimate is that our exports to the US would drop by as high as 31 billion. At 30% tariffs, it would be about 40 odd billion. So obviously, as the tariff uh, number or the incremental rate of the tariff imposed on India increases, the loss in exports would be higher. As I said, at present, given that India's weighted average tariff on the US for all commodities is about 9.5%, rounding that up to 10%, we think that a 10% incremental tariff and then be imposed on India, and that it leads to our number of 6 billion loss in exports next year. But as I said, that is on a broad country level. Now, as we've seen with the announcement of possible tariffs on auto this morning, there could also be certain sectors that are targeted. They've already, for example, imposed tariffs on iron and steel earlier this year as well. So there could be possible sector level tariffs as well that come in. So what we've done is we've also done a little bit of analysis of each sector. So on a prima facie basis, obviously the tariff differential that India has with the US across broad sectors is the highest if I look at comparable countries as well. And across sectors, as I said, India has some of the highest tariffs. But what we've done is we've gone into the details of each sector after our identification and tried to see if there are mitigating factors for any of them where the vulnerability is less or more than what is being spoken of at present. So before I get into the sector level work, it's important to note how concentrated India's exports and imports with the US are. So I'll just quickly sort of show you the top 15 exports and imports that India has with the US as of FY24. So if I look at exports, this is at HS2 level export and sort of trade data. Our total of about 77.5 billion, the top five alone would be close to half or just under half of that total. Electronics, gems and jewelry, pharma, machinery and parts and of nuclear reactors or otherwise, and refined petroleum. These five alone would be easily at least half of this number. And if I look at imports, it's a lot even more concentrated. So nearly one third of our total imports from the US is just crude oil, natural gas, and coal. And looking at the other top five, again, it would be easily more than half of our total imports. So it's quite concentrated. And therefore, the hit will come to those sort of large sectors because, again, if I, excuse me, if I look at the distribution of India's exports and exports to the US across HS2 level codes. So there are 98 HS2 digit codes for trade data. In that, 75 have had an export value of less than 500 million, so less than $500 million last year for the full year, for the full FY24. And if I was to aggregate these, the value of each of these codes as well, so the aggregate value of these 43 HS codes was just $1 billion. The aggregate value of these 32 was just about 8 billion. So these two combined is about 9 billion, just under 9 billion. Whereas the five HS codes that made up that had an individual, value of at least $3 billion, they combined for a value of 41 billion. So out of the 78 billion that India exported to the US, more than half is coming from just five HS codes, five broad categories, 41 billion, five broad categories. So that's essentially what we're saying, that the hit will be concentrated to, if at all optically, will be concentrated to a few large sectors where the exposure to the US is high, and the rest essentially we don't export much to the US in terms of value or the share of the US in that sector for them to be hurt materially. I'm not saying there won't be an impact, but the impact may not be material. So how we've sort of arrived at that is also by, so what we've done is of those 98 HS2 digit level export data that we have, we've excluded all the HS2 codes which had an export value of less than 300 million last year. So all the low value items have been excluded. And then we've sort of plotted them along two axes where we've looked at the tariff differential, the relative tariff differential for each of those sectors with the US, and the share of the US in that sector's total exports. So if the US is an important market for that sector or not. And the basic sort of outline is that these two quadrants are therefore the least vulnerable or relatively less vulnerable, and these two quadrants are the most vulnerable. So I'll just quickly run through the individual sort of quadrants as well in terms of the charts. So this one where the share of the US in the sector's exports is less than 10% and the tariff differential is less than 10%. The only one that shows up here is mineral fuels and oils, which is essentially India's exports of refined petroleum products. This is the least vulnerable because, again, the US is only about 7 odd percent of total exports. Tariff differential is also low. So if at all tariffs are imposed here, the US is not a big enough market, or rather, it's not a huge market. It is a big market, but it's not the most dominant market for our refined petroleum exports, and we can shift that demand elsewhere quite easily. Demand for refined petroleum is obviously global, and the hit therefore here will be much less, and therefore this quadrant or this particular category essentially, because it's the only one here, is the least vulnerable. Coming to the next one where it's a little more vulnerable, but the value is quite low. So you can see three sort of broad commodity groups here, which is cereals, coffee, tea, and spices, and iron and steel. But the size of the dots, as you can see, is extremely small. It's barely above 300 million, which was my filter in the first place. So the share of the US is again quite low, even though the tariff differential is very high, over 70%, for example, in the case of coffee and tea and so on. Because the share of the US is quite low and the value itself is also extremely low. Again, if these are tariffed at high rates or even at a lower rate or whatever, we don't sell or we don't export enough to the US for it to make a material difference. So therefore, these two sort of quadrants are the ones where the impact is likely to be minimal at best. The next two are the ones where there is likely to be some significant impact, at least at a first glance. So this one is the most vulnerable, where the tariff differential is quite high and the share of the US in the sector's exports is quite high. So over here, you see vehicles, which is not just finished vehicles, but auto components, all of that combined. And certain food items, so fish and crustaceans, meat and fish preparation, certain items of textiles, so furniture, bedding, cushions, so on and so forth, carpets, all of that. So we've aggregated these and then looked at them specifically later on in the report. But these prima facie are the ones that are most vulnerable based on the criteria I just mentioned. And the last one where most of the sectors lie is where the share of the US is quite high. Again, this is logical because the US is our largest trading partner. Almost 20% of our exports go to the US. So most of the sectors will lie in this sort of area where the US is an important market for them. The tariff differential here on a sectoral basis is not that high relatively. But if I look at the three largest ones in terms of value, so pharma, electronics, and gems and jewelry, these are the three large value items where even 10% tariff would be detrimental. So we've identified, then from this quadrant, we've identified these three primarily as again being the most vulnerable at the first glance. Now I'll quickly just get into each of those sectors which we've identified previously to talk about whether they are actually that vulnerable or there are some mitigating factors that we feel could protect them or insulate them from tariffs. So firstly, if I look at electronics, for example, our exports of electronics to the US last year was about 11 billion, which is 14 odd percent of the total exports to the US. And if I look at electronics as a whole, as a sector, about 1/3 of our exports went to the US. So total electronics exports was about 34 billion, and exports to the US was about 11 billion, so about just under 1/3. Obviously, that means it's an important sector and the US is an important market. But of that 11 billion, more than half was smartphones. So HS8517 is mobile phones and components. Now, obviously, we don't export components to the US. We export a final product, which in this case is smartphones and specifically the iPhone, which gets assembled in India and then sent to the US for retail. So about $6 billion worth went to the US of the total of about 11 billion of total electronics exports. And it is this that we feel, will insulate or protect sort of the sector from being tariffed, because obviously Apple is the company that makes iPhones. It's an American company. It would be extremely counterproductive for the US to tariff imports or shipments of an American company coming into the US. And the nature of the value chain that or the role that India plays in the Apple sort of ecosystem or value chain at present also means that tariffs would be counterproductive. They won't really serve any purpose. Because if I look at the value of the final retail value in the US of an iPhone, say it's $1,000, India's export value is about $500. Now, the remainder gets added after the export from India to the US after the landed cost, where it's essentially fees that are paid to Apple and to US retailer margins. So 500, but the point is that even at $500 of export value, India's importing components and raw materials worth $470 to make that $500 export value. So all the sort of semiconductors or modules and everything that we import from China, Korea, Taiwan, and other countries, because we only assemble in India. We are not really manufacturing the phone in India as such. So the assembly value add is only coming up to about $30 per phone. And that is without accounting for PLI and other schemes. If I actually account for all of those incentives that the government is giving at a broad economy level, the value add for the per phone is virtually nil. So when there's hardly any value add happening in India to the value of the phone that is being retailed in the US, imposing tariffs on India is counterproductive because there's no value add happening here. The cost will simply be passed on. It's either Apple, which will take a hit on its margin, or the final US retailer who will have, or the consumer who will have to pay that higher price for the tariff. And given that China is already being tariffed at 20% and it accounts for 85% of global iPhone shipments, India accounts for 15%. Apple is trying to move obviously away from China. It has a stated goal of trying to hit 25% global shipments from India in the next, I think, a few years, 3 or 4 years. Then the tariffs on China do not exclude electronics. So those iPhone shipments from China to the US are already being tariffed at 20%. Imposing then tariffs on India as well is counterproductive. Apple, obviously being an American firm, will take the hit, or the consumer will take the hit. And we believe that there could be significant lobbying that happens. If at all, electronics does not see a carve out, or iPhones or phones or whatever don't see a carve out, and therefore. And as I said, even if those tariffs are implemented, India will not be hurt. The assemblers in India will not be hurt because the tariff is being levied in the US at the final port of when it lands in the US. Those costs will have to be absorbed by the US entities and not India. So therefore, we feel this sector which is the largest sector in terms of, as I showed earlier, the largest exports to the US, is relatively insulated. The two sectors which are actually not that insulated, which are exposed and which have very little mitigation in our opinion, are gems and jewelry and textiles and apparel. So I'll come to gems and jewelry first. Now here, again, the US is an important market, took up about 30% of our total exports of the category. So of 33 billion total exports, around 10 billion went to the US last year. And this was mainly the two biggest categories within this were refined polished diamonds and studded gold jewelry. Now, the dynamics of this sector are such that, first of all, the tariff differential is quite high. So for most categories, we impose about 20% tariffs, and on diamonds, we impose 5%, which is, given the value of diamonds, obviously it's still a significant number in value terms, even a 5% levy. Now, the problem is that it is an extremely labor intensive sector, and therefore even a small shift in demand away, if tariffs are imposed on India, even a small shift, say 10-15% shift in demand from India to other countries in terms of their supply to the US, will hit our employment much worse. And there are countries in the Middle East, there's Singapore as well, for example, who have FTAs with the US, and who have some of these capabilities. So demand can quite easily shift there, and the cost will obviously be lower because these countries are not going to, at least at present, do not seem like they are going to be tariffed next week or even sometime later in the future. So with those dynamics, even a small shift in demand away could hurt the employment sort of in India quite heavily in these sectors. And there's not a lot of mitigation here. The only thing we can possibly do is increase gold and silver imports from the US. Most of our gold imports come from UAE, and most of our silver imports, for example, come from and Switzerland as well, and silver comes from Great Britain, for example. These are largely commoditized. Maybe some of them can be shifted away, some of the imports can be shifted away, and then we can offer some mitigation, but not a lot of mitigation exists for this sector. It's a similar story for textiles and apparel as well, where we believe that there's not a lot of mitigation. So of the total exports that we did to the US, majority is apparel and sort of home furnishings and so on. US is an important market for us. 1/3 or even more than 1/3 of our total exports within these categories goes to the US, but we aren't an important market for the US. If I look at apparel imports, China, Vietnam, Bangladesh are the three largest. China and Vietnam have at least 20 odd, almost 20 odd percent each. Bangladesh has just under 10% share. India has just 6%, even though it's the fourth largest. So we aren't an important market, and again, the nature of the product is such that supply can be shifted quite easily. Vietnam, Bangladesh have already gained market share globally over the last 5 years at the expense of India. And even if tariffs are imposed, so China is already facing tariffs of about 20% on its apparel imports into the US. So we are competitive versus China, even at say 10-15% incremental tariff if imposed. But Vietnam and Bangladesh are not facing any tariffs. In fact, Vietnam has a negative tariff differential. US tariffs on Vietnam are higher than Vietnam's tariff on the US. So Vietnam is unlikely to face any tariffs. Bangladesh is too small an economy and too small, the number with the trade number with the US would be too small for it to be targeted. So Vietnam and Bangladesh are unlikely to face tariffs. India, if it faces tariffs, obviously the cost advantage, the cost differential increases, and essentially Vietnam and Bangladesh would take up even more market share. And again, these are labor-intensive sectors where the employment rate would be high. So, and again, very little mitigation exists here. So these two, therefore, are the sectors where we feel which are the most exposed, essentially, and the most vulnerable with very little mitigation. Now, coming to automobiles, which obviously is in the news today because of the announcement of, say, 25% tariffs on non-US made automobiles. Now, we feel India is relatively, again, I'm not saying it is not exposed, but relatively less exposed because of the nature of our trade with the US. Now, again, 2.6 billion worth was done of exports of automobiles and components taken together to the US last year. So that was only about 13-14% of our total exports of this category to the world. So 21 odd billion, may say, it was only about 2.6 billion. Not a large market as such. And even within that 2.6 billion, 80% is parts and accessories. We do not export, cars and bikes in CBU form to the US in the first place. It would be less than 200 million. So tariffs on the final car or bike being imposed, whether it's the 25% announced today or a reciprocal levy of say 100% or whatever, because that is what we impose, will not really hurt our market because we don't sell those to the US in the first place. Components obviously is the major chunk of our exports to the US. That was at the reciprocal level, the tariff that should be imposed or would be imposed would be 12, anywhere between 10 to 15%. Even at the 25% level that was announced today, if that applies to certain components, that obviously is a hit. But there again, it's the relative story that comes into play because China again is already being tariffed at 20%. This number is incorrect. It shouldn't be 42. It should be 22%. So China is already facing 22 odd percent tariffs on its auto component imports into the US. Mexico, Canada at present have a carve out where their auto component exports into the US are not being tariffed. But that exemption was only supposed to last for a month. Trump has already today, as he said, announced tariffs and said that no exemptions will be given or whatever. Or maybe there'll be a further exemption of a month or so. But eventually, if those imports into the US are also tariffed, we could still be better off because at 12.5 we would be better off. Even at 25% we may be better off depending on the modalities of the tariffs on Mexico, Canada, if it's a further incremental or whatever. Because Mexico, Canada, China together make up nearly 2/3 of auto component imports into the US. So, and we are just 2%. So if the three largest suppliers are being tariffed heavily and we are tariffed less heavily or less, strictly, we would be better off on a cost basis. But of course, this is, the gains from this, if orders for India could increase because it's after tariffs we are cheaper or whatever, that will take a long time to accrue because North American auto supply chains are heavily integrated. Factories are literally across the border with each other. Parts cross the border multiple times in the car assembly process in North America. So any gains, any reorganization of supply chains will take a while to accrue. So there could be some hit to auto, but as we said, it's less than what is being feared. And you will see that in sort of the stock market reaction today as well. A lot of the OEMs have not reacted because they don't have any exposure to the US in the first place. Now, quickly about the easy wins that Madhavi spoke of earlier that we believe. So these tariffs are not an economic sort of rationale behind them. There's a lot of political and other sort of angles that these tariffs are being imposed. And Trump loves a deal essentially. So we should offer certain concessions which we feel are easy to offer because they will not hurt us domestically, but they can also serve to be used by the US as a win for them by saying that because we were threatening tariffs or because we imposed tariffs on India, these are the concessions they've given us and therefore they work and blah blah blah, whatever political considerations they have to meet. So these are the broad four sort of tariffs, concessions that we feel can be offered by India without hurting us domestically. I'll quickly run through them. So, increasing energy imports. This is something that's already been spoken about by the Prime Minister when he visited the US in February. It's quite easy to do so, given the fact that the US, or rather, we import a lot from Russia at present, but that's only because the Russian crude discount was very heavy. That discount is declining, so the incentive to buy from Russia is declining, and therefore we can easily increase purchases from the US, even though the cost of buying from the US is higher in terms of logistics cost. Is about $4 a barrel versus $1.5 a barrel from West Asia. But you can easily enter a deal with, say, X. You can sort of at saying that we'll buy X amount or X million barrels or whatever from the US, even if it's at a slightly higher cost. It's something that can be offered quite easily. And in the case of natural gas, it's even better because the landed cost of natural gas from the US is cheaper than that of from Qatar. So even after accounting for logistics and whatever other costs, and the US is already a second largest supplier, so we can easily ramp up natural gas imports from the US. So increasing energy imports, bit of a no-brainer, can do it easily, and offer that as a concession to the US. Similarly for defense, obviously a lot of discussion has already happened out in the public domain and all of that. It'll help us modernize the military, move our dependence away from Russia, which is extremely heavy at present. Nearly 60% of our large military equipment imports since independence have come from Russia, which makes us dependent for maintenance, spare parts, and so on. Has obvious strategic and geopolitical, advantages as well. So these two are broad level items which we feel can be done quite easily and will help, at a high level, reduce the deficit that we have and serves as messaging wins for the US as well. In terms of agri, it's nuanced because obviously we do have high tariffs on agri products, very high, 50, 60, 70, 80, even 100% on certain goods, on certain food commodities. And this has been something that's been brought up multiple times by the US in the past as well. So we're not advocating for a complete fall in agri tariffs that we impose, but there are certain areas where we can do that because of the dynamics that are at play. So one where we can do that quite easily is fruits and nuts. So 4 billion worth of fruits and nuts imports were done by India last year from the world. 25% of that came from the US. So 1 billion came from the US. And this was despite a tariff rate of 17%, 17.5% nearly. So despite a high tariff rate, if you're already buying from the US, it makes complete sense to reduce the tariff rate and buy more and therefore reduce the cost to domestic consumers. So what we buy from the US in fruits and nuts is essentially apples. The vast majority of our imports from the US are apples, and then you have certain nuts and berries and so on. So you can easily buy more by reducing the tariff rate and therefore reducing the cost for yourself, for your consumers domestically. And again, it's a win that you can project to the US that we're buying more of fruits and nuts from you. The second one where we feel within the food sort of category where we can buy more from the US is pulses, because we are the largest importer of pulses in the world, and the US is the fourth largest exporter of pulses in the world, but we don't buy from the US. 1%, less than 1% of our pulses imports came from the US last year in terms of the value. And we can easily buy more given the fact that Canada is our largest supplier. It doesn't seem like logistics costs is a concern. If we can buy so much from Canada, we can easily buy from the US. Can be done in the form of a quota deal where X million tons or X 100,000 tons per year can be exported to India at a very low tariff or without facing tariffs, because that is exactly the deal we have with Australia, which is why Australia is our third largest supplier. So these two areas within food we feel are easily achievable. Again, achieve all the aims we've spoken about earlier. And the reason for doing so is to essentially all of what we've spoken about is to protect the areas where we are vulnerable. So textiles and gems and jewelry, we are vulnerable. So you offer these wins and say and ask for no action or no tariffs on the areas where we are vulnerable. And even within food, the only area where we are vulnerable is seafood, because we do not export food to the US. The only big ticket item or big value item within food that goes to the US is seafood. So about 2 billion went to the US last year. If I add meat and fish preparations to that, it was about 2.5 billion, which is almost half of our total exports of food to the US. These would face reciprocal tariffs of as high as 24 to 27%, so essentially about 25%, if it's done on a sectoral basis. And therefore, given the fact that again it's not something that is extremely tech heavy, seafood can be bought from anywhere else if costs are high from India, and again it is labor intensive. So protection is required here. Offer concessions elsewhere, try and get protection here. That should be the strategy. There is just one, before I get to that, sorry, the last category or the last concession that we can offer, which is already in the pipeline given that the EV policy has been notified, is lowering tariffs on EVs, which would allow Tesla to enter. And given how, intertwined Elon Musk has been with the current Trump administration, this would again be something that would go down very well, very favorably. Uh, this would not hurt domestic OEMs because current EV penetration is never crossed 3%. It's just about 3% in March data, whatever we had so far. And the price point at which Tesla would enter, the cheapest Tesla is at $35,000 retail, if I remember correctly, and accounting for tariffs and all of that, whatever the lower tariff rate would be, 15% or so, it would still be at about 35 lakh or so retailing in India. And there's hardly any EVs that sell at that price in India other than the ones that are manufactured. So BYD, which is a Chinese firm, Kia, which is a Korean firm, those are the only ones that sell at those price points. All the Indian OEMs sell EVs at much lower price points, so Tesla wouldn't even be competing with them in the first place. And in fact, given the way in which the EV policy is being formulated, there is a requirement for domestic value add. So the savings from the tariff reduction that these firms will be getting will have to be invested in local manufacturing and local capacity creation with a view to achieving 25%, at least 25% domestic value add by the next 3 years. So if that actually is the way in which the policy will be implemented, Indian component manufacturers will benefit because at the Tesla will then have to start sourcing locally to meet that domestic value add requirement. So all in all, again, will not hurt domestic OEMs, at least not in the first leg until Tesla, say, becomes competitive and can price lower, and will actually help domestic auto component manufacturers. So again, this is something that can be done without hurting us domestically. And the one sector where we India actually has some bargaining power and is in a stronger position is pharma, because we made up only 6% of the US pharma imports by value last year, but by volume, especially of generics, we were just under half, just about 47% of their generic imports by volume. So we are a low cost, and high volume provider of drugs to the US. And we've consistently, if you look at Indian firms, the FDA market authorization, which essentially allows them to sell and in the US, Indian firms have been the largest among other countries to get market authorizations. So the most market authorizations by the FDA have come to India. So we are essentially a big player in the pharma market and a low cost provider. Other providers of generics are much more expensive. So at such a juncture where bringing down domestic healthcare costs is a key sort of policy prerogative for the current government and even for the Democrats. It's one of the things on which both parties agree in the US. They would not want to increase the cost of their medicines, and our pharma sort of the analysis that our pharma sector analyst has done basically tells us that if at all Indian pharma exports are tariffed, Indian firms will either exit the US or they will simply pass the cost on to the US intermediaries and therefore to US consumers. So they will not be hurt. Because of the bargaining power we have, we will not be hurt in this sector. And that's essentially, as I said, we are in a stronger position. This is one of the areas where we can actually bargain hard and try and exclude it from tariffs in the first place. Obviously, we'll have to see how it goes. So that is the sort of broad sectoral analysis. As we said earlier, we've sort of looked at which sectors are actually vulnerable or not. And the last bit of the report is looking at whether India actually has any export opportunity from the current tariff war, because this sort of round of tariffs is much broader than what it was than the scenario we had in the first Trump presidency. Far more countries are being targeted, many more sectors are being targeted than it was last time around. So it stands to reason that there may be questions around, India can maybe benefit if China is being tariffed heavily or other countries are being tariffed heavily, we can enter those export markets. But the answer that we found is that the opportunity is very limited, if at all. And the reason for that is China will remain a big player in global markets. So last time around, China basically rerouted exports. China lost market share in the US, but Vietnam, for example, the amount of exports to the US went up substantially. And this was essentially Chinese exports being rerouted. Mexico has also seen the same sort of phenomenon. And obviously, we don't know how tariffs are going to evolve over the next few months and years, but it's quite likely that China will continue to do the same. And secondly, more importantly, India and China are not competing in the same brackets, in the same markets, in the same products. So China has obviously gained in high-tech products EVs obviously being a prime example, but even solar cells, batteries, China has become the world leader in the last 4 or 5 years. It's gained market share in a lot of high-tech sectors in terms of global export market share. But the areas where China has given up market share post-COVID, which is more low value add, low skill, India has not really gained in those markets other than telecoms, which is what we'd spoken about earlier, the assembly of phones that we are now doing, assembly of smartphones. So that's the only area where India has gained market share and China has lost market share. Other areas where China has lost market share, we have not gained. We've only gained sort of in some agri products and some other primary goods. So we are not competing in the same spaces, and therefore, if at all China loses out in some products globally due to this tariff war, India will not be the one to gain. It would be probably some other countries. And lastly, even with tariffs on Mexico and Canada, prima facie simulations show that India could gain in some products here and there. But the reality is that uh, again, not as I said earlier, North American supply chains are extremely integrated. It'll take a lot for to them to, rather than buying something from Mexico at a higher price, choose to buy from India, for example. It'll take a lot of disruption for that to happen. So essentially, in two lines, if I was to summarize what we've been trying to say, is that both the benefit and the cost of these tariffs at present, depending on what the current scenario or what we think the imposition will be, looks to be limited, because at 10%, as we said earlier, the loss to India's exports to the US is only about 6 billion. But at the same time, this global tariff war doesn't look like it'll benefit India um, from an export point of view. And of course, if the tariff imposition is higher, if the rate is higher, then the loss is higher. But we have to wait and see and we don't think this will stop on 2nd April. It's going to probably be something that will be noisy, and more announcements will keep coming after 2nd April as well. So we'll have to wait and see as to what the actual imposition is.
I think we can stop here. If there are any questions, we can address those. Anything people want to ask on the market implications, we can also cover that. This report obviously did not cover the market aspect of the same. But we can also address those questions if there are any. There's one
So,
question I can
yeah,
see.
Suresh Iyengar. You want me to read out? From Suresh is from Business Lines is asking, does sectors to be hit like auto, electronics, gems, apparel, jewelry, pharma have any other alternate markets to export if US becomes unviable?
So it depends. Again, it's very it's sectoral. So auto, for example, as I showed earlier, the US is not it's about 13% of our total auto exports. So it's not a big market. Some of it could be rerouted to other countries. Refined petroleum probably easier because demand for refined petroleum is global. But it's again something that's dynamic, because tariffs will not be introduced only on India, right? Tariffs will be apparently on 15 or so countries on 2nd April, possibly more. Tariffs are being introduced on specific sectors or specific commodities as well. So iron and steel, auto. Trump has threatened tariffs on pharma, semiconductors, irrespective of where they originate from. So it'll be it's extremely difficult to say whether they can be rerouted or not, because other countries' exports are also going to face tariffs. Where will they send? All of that is something that we'll only find out, and I would say not even immediately. We won't even find out on 2nd April. Even after 2nd April, as these things start to flow into the system, as the global trade actually gets hit and we start to see flows changing, is when we'll probably get a sense. Some of it can be rerouted, in short. Some of it can't, because for some sectors the US is too big a market. For others, where the US is not too big a market and there is global demand, we ex-US, we may still be able to reroute, but a lot depends on how other countries are also tariffed.
See,
It's very
generally
dynamic.
generally these value chains don't change immediately, right? Any kind of shift in terms of manufacturing order takes forever. So they'll have to, as he was saying, that you'll have to again do a cost benefit analysis as to whether it still makes sense despite the tariff that is being imposed on you to sort of look for a new market, or even from the end consumer point of view, whether with the tariff which is imposed on the goods that they're consuming, on net they are still probably cheaper than the ones that they would have otherwise gotten. And there's also some sort of a demand elasticity also that exists. So there will be a resistance in terms of changing, uh, you know, the production pattern, export pattern, and even import pattern and consumption pattern. So it's not going to be easy. The short answer in this process is going to be, of course, the end consumer might end up actually paying much higher price instead of the exporter immediately feeling the heat of it at this point in time.
Sanjeev has a question. I'll just allow him to
Yes, Sanjeev.
unmute.
Yeah. Sanjeev, you're there? Can you unmute and ask your
I'm
question?
muting it.
Yeah,
Yeah. So the tariff regime will be basically sector-wise, or since he has already announced that there's 25% on auto sector,
correct.
auto imports. So this is going to be sector-wise now, because
No, we
yesterday,
don't know.
We do not know that. So he's not followed any
okay.
pattern
So
per se, right? He's very, it was not supposed to be even announced before 2nd April. So there is no
yeah.
clarity on the
So
way. So if the first chapter of our note itself says that, it could even go tariff line wise also. So he has a lot of whims and fancies in terms of how he's going to impose the tariff, right? It could be, wherever there's a lazy way of doing from his end could probably lead to him putting a broad tariff, and then again, despite putting the broad tariff, you may actually come out and say, okay, while there is a broad tariff, we could also get into the sectoral aspect of it, and probably within the broad tariff category, there could be sectors that I would sort of target, and maybe countries also probably he would separately target if, apart from putting a broad tariff on them. So we do not know the nature of it. It is all speculative,
mhm.
and as Herschel also mentioned, it's not going to be the end of the a resolution of any kind
Announcements.
of there's not going to be a resolution coming out of clarity coming out of the 2nd April announcement, but probably will lead to more confusions because if he's not prepared and if he hasn't done his homework very well, in all likelihood, it will be again very vague, broad outline that would be given out, and which will lead to a lot of confusion in the market as to how much would be the hit. Like for example, we were talking about the auto sector. We still don't know exactly, how much of the auto component segment actually will be targeted. There is no press release just come from the US government side. So there will be a lot of noise with regard to what tariff lines, if at all he gets into sector and subsector point of view, it will be very difficult for us to navigate also, and for them also, the US administration when they are imposing into two different countries. So we do not know. All we can probably do as an exercise as policy as analysts is to play around with the scenarios, and that's what we tried to do. We do not know and I don't think even the US administration is currently ready with an understanding as to how they're going to play country wise, commodity wise, sector wise, subsector wise, sub tariff line wise. There's one segment where which actually shows that, given the way the US is in a global market, the importance of US is in the global market, they have around 2.5 tariff lines with the 200 countries that they export and import with. So basically, given it's important as a trade partner, it will be very difficult for them to first do their homework and go ahead with, a sub-segment or a tariff line-based imposition. So we'll see how it pans out. As of now, no clarity is what the best answer that we can give you.
All right,
So,
got it.
yeah, I think Aditya's question was also on those lines that what are the implication on auto component stocks? And Vikas had a question about how's the steel industry, expecting the tariffs to play out. So I think
Actually,
Madhvi, you answered a part of it. Harshal, you want to go take a
Just
go ahead?
specifically, I'll say steel specifically, we don't export a lot of iron and steel to the US in the first place. So I don't think, again, not done a deep dive into it, but prima facie, we don't export a lot of steel to the US in the first place. So the implications are minimal at best, in my opinion. Um, on auto and auto components, as we said earlier, still no clarity. It's just a number that's come out yesterday, last night. No clarity on what level of, whether it's only at the final vehicle level or components are also going to be tariffed, which components are going to be tariffed. OEMs, as I think we've seen from the market reaction, only those OEMs which have major US exposure have been are a little bit negative today. Most of them don't. So Tata, for example, does through JLR, but Maruti doesn't, for example. So at the OEM level, it'll depend on that. At the auto component level, obviously, then there's even more, uh, uh, you know, the nuances, because a lot of the component ancillary manufacturers and so on have facilities in the US itself, so they may be insulated and so on. So as I said, extremely unclear at present.
and we
We'll
don't
have to
even
wait
know
and see what the
whether
actual number is.
they are including two-wheelers and motor vehicles also. They've not really mentioned that very clearly in the notification or whatever is the pressure that has been talked about.
Yeah,
I
and
think
then
we're not the best guys to talk on the company point of view. I think our media desk will be sharing our auto analyst
yeah,
views on the
yeah.
same
So
separately.
Chirag covers auto for MK. Meanwhile, Bharat has question on can you expand on demand due to tariffs? How do you see the impact on foreign flows due to inflationary pressures due to US tariffs?
Can you expand on the demand due to the tariff? So basically, demand hit that can come on the US, because obviously that, see, very difficult to say, but what we have been sort of reading from all of these think tanks that have covered the growth impact in the US, most of them are looking at around 1.5 percentage point fall in the US from the baseline growth forecast. So that, if you can take as a proxy of a demand destruction, which is around 1.5 point, again we're talking from the US point of view. Domestically, we will be seeing an export hit to the extent of, if our numbers are correct, say up to, if we face around 10%, we don't know exactly what will be the net tariff hit that we will face. For any 10% additional increase in tariff, we are facing around 6 billion worth of export loss, which is very minuscule from a equation point of view, for our growth equation point of view, which is as low as 0.1, 0.2% of GDP. That will be a hit via CAD, and it will feed into our GDP equation as well. It will be a bigger hit for the US as of now, assuming, as I said, the first leg would be a price shock and a growth shock, right? Of course, because immediately the demand elasticity will not be very high. But once the prices start percolating in, and if there is actually a growth destruction that happened in the US, there would be eventually a slower demand that will seep in, and which will hurt their export partners, which are basically the likes of India, China, whoever is basically exporting massively to the US. But the first leg will be a bigger hit to the US than to the nations who are exporting into the US, because it's basically self-inflicted pain that the US is putting on themselves. Which essentially, if I take the aggregation of IMF numbers in Oxford, and I think Yale University also had done one research on the same. Mostly, they are all sort of saying it will be 1.5 percentage point lower than their baseline projection. So it could go, if the baseline was around 3% growth this year, it could go down to a 1.5%. If the baseline is 2%, it could go down to a sub 1% growth this year. But recession at this point in time is still a discussion point, but not necessarily a very high probability scenario at this point in time, even from our end as well.
Okay, so while you answered that in a flow, but Bharat still has a question that, the markets have snapped a monthly losing streak and set to gain in March. What's your outlook for FY26? The first March
Indian
approaching.
market snapped the market.
Yeah.
It's on equity markets, but I think, see, markets globally are anyway, are basically watching out what's happening on the trade uncertainty front. We are entering a world where there will be a lot of noises with regard to, the trade segment. The trade tariff war is unlikely to subside until, unless, of course, you actually see some sanity prevail in the US and they start to, retrace their or backtrack from their earlier announcements. As of now, I think till the time we get more clarity on the tariff front, it's just going to be very noisy. For emerging market as a whole, last 2 or 3 weeks where you saw a massive correction in the dollar, a lot of market participants are expecting that should be good for emerging market, because historically a weaker dollar has augured well for EMs, including India. Flows come to domestic markets, so because people assume a weaker dollar is basically a foreign flow diversification or a carry. Chase the emerging markets in general. That essentially may not be the case in the current scenario, because a large part of dollar weakness that you have seen in the last 1 month or so has not necessarily just come because of dollar losing its US exceptionalism status, but also because of what's happening within the developed markets, where there's been like a historic shift in the way Europe is now looking at its fiscal stance. They were pretty stingy in terms of the fiscal expansion post COVID. US among the DMs had actually unshackled a massive fiscal support, which also helped the economy do better than other peers. And that difference is now looking to be fading. And of course, there's some bit of a easing in the US growth also that has been seen. But that's also because of a lot of uncertainty that is hitting them more than the actual data. So, we'll see how things pan out, but I think uncertainty is not good for emerging markets. On one hand, a weaker dollar is positive for us in terms of market flows, in terms of the market positioning. But a large part, on the other hand, negative sentiments or a lot of volatility around the trade dynamics would be keeping, investors or foreign investors a little more bit edgy with regard to taking a very structural position on the emerging market. It could be tactical positioning here and there. We do not think that it's something which is a secular bull market for emerging market till the time we get some clarity on this. And God forbid, actually, this turns out to be worse than most of us are expecting, and it just gets dragged through the year, and sanity does not prevail in the US, and we end up looking at a recessionary state. I think any first leg of recession sign which starts getting more definite tends to actually gain dollar into its positioning than actually be anti-dollar, because dollar has a anti-cyclical nature, which basically means whenever there's a risk aversion in the markets globally, people move away from emerging market and high beta countries like India and move back to the base country or currency where there's a so-called natural safe haven which is there, which of course changes as policymakers respond. So if there's a Fed response which comes with a big stimuli, people start looking at asset reflation and start looking at carry trade again. But the first leg of uncertainty is always very difficult for emerging markets on net. You can have cherry picking. India was all this while a very expensive market. There was a massive outflow that happened, which makes it look at least better than a few of our peers. And also, as we were mentioning in our thesis, that in this whole dynamics and whole drama that is happening in tariff front, we are not necessarily the bigger loser compared to maybe our bigger peers, because we are a much smaller export market. So if our domestic economy is better held this year, we could still be a relative player in the EM space, and people might want to invest in India. But that said, on directional basis, very difficult to take a call on a positive trend line, uptick or a secular uptick in risk markets like India, unless, of course, there's much more clarity on where the global cycles are now leading.
Okay, thank you, Madhvi. I think Bharat's last question was pertaining to valuations and earnings. So I think the sectoral analysts would be the right people to answer this. So
You
Bharat, you
can,
can,
Amit, you can share this, our
yeah.
Sheshadri, the strategist, HR and strategist report from last week. I think that would have the
Yeah.
his sector picks,
Yes,
you know,
yes.
overweight, underweight, neutral, whatever they are.
So any other questions? Last call for questions. And if you have questions beyond after this webinar is ended, you can reach out to us through our PR team, or you could write to us on media@mkglobal.com. So that's it from our end. Thank you so much, Madhvi. Thank you, Harshal, for this enlightening thing. I got a whole lot of stuff that I can write now and appear like an intellectual despite being from marketing.
Thank you, guys. Thank you for
Thank you,
joining.
guys. Thank you so much. Thank you so much for coming in. Bye.